Slappy shout, look, he's trying to throw loyal fans a curve. What's he doing, eating fish or vegetable dish? Man, he sure got lots of nerve. Well, me answer you straight when you filling up plate, taking only cookies, all wrong.
Hello and welcome to episode 196 of the Rollo and Slappy Show. Today is April 27th, 2020. I am Rollo McFlugel, and with me is Slappy Jones 2. Show notes page for this episode will be mcflugel.com/196, where you can check out our sponsor, libertymugs.com, where we have awesome libertarian-themed mugs and other things like t-shirts and stickers, and even a clock that will tell you when it's time to buy Bitcoin. And also, check out the show notes page. We're going to have a bunch of links for our guest, who Slappy will introduce right now.
And our guest today is Andy Edstrom. He is a CFA, a CFP, financial advisor, and member of the investment committee at the Westcap Group, where he manages wealth and provides financial advice to clients. Andy is the author of the book, Why Buy Bitcoin? Investing Today in the Money of Tomorrow. Welcome to the Rollo and Slappy Show, Andy.
Thanks, guys. Great to be here.
Yeah, so today we're going to talk about the market, essentially. What's going on? What's going on with the Federal Reserve? What's going on the world stage? And so, Rollo, how do you want to kick this off?
Well, I think maybe we should take a step back a few weeks or maybe a month. I've lost track of time since.
Me too.
Yeah. So, Andy, why don't you kind of say we're in a crazy time. In our last episode last week, we're talking to Carr about all the stuff that the Federal Reserve's doing, everything that's going on in the economy. But we didn't really go into too much detail about it. We just kind of went over the top about it. But
some of the things we're hearing is, I guess, a zero reserve, 0% reserve requirement, and they're printing $8 trillion or something like that. What's going on there? What does that mean?
Yeah. Gosh, there's so much going on. I've spent my career in financial markets, and it still makes my head spin. I'm just holding on for dear life, trying to keep track of what's going on. But yeah, high level is we are in uncharted territory, and the Federal Reserve and central banks around the world are doing stuff either that they've never done before or that they haven't done in a century. And so that's the big picture. You mentioned, the reserve requirements. Yes, the Fed has, the Fed, which is, the primary regulator of the banking system. It's not the only one, but it's the primary one, has relaxed the reserve requirements for the banks. Basically, that said, the idea with bank capital is you're supposed to have some capital as a bank in the event that things go wrong and you can sustain some losses. And what the Fed has said is, we're going to push a ton of money into the system, and we want you to, continue to let that flow through right into the economy. Don't worry about holding on to reserves. We want to get money to as many companies as fast as possible. So that's the big picture. And then, we've got this whole alphabet soup of asset purchase programs. We had that in 2008 and 2009. Basically, financial markets fell apart in that crisis, and the Fed had to start buying up assets of more and varied types. And they're doing it right now also. So, they started with, the usual quantitative easing stuff, which is the Fed creates money, prints money, and buys government debt. Then that was extended to mortgage debt. It's been extended to now, this is a new thing, to junk debt, right? This is bonds of junk-rated, non-investment grade companies, i.e. highly levered, highly indebted companies. I mean, first, of course, they started buying investment grade corporate debt, but now they're buying junk debt. Indirectly, they're not literally buying the new issues per se, but they're buying exchange-traded funds that hold them. And so it was just announced earlier today, as I think you noted, that they're buying municipal debt in larger amounts. So basically, cities, municipalities that can't afford to pay their bills, that have problems, They're buying up their debt. So essentially what this means is buying up the debt of all these entities in the economy means that they're supporting them by effectively lending them money. And so, yeah, the Federal Reserve is a central bank, and it was always supposed to be the lender of last resort, but it is now the lender of last resort and first resort, essentially. And there's also these programs whereby the Fed is funding, or excuse me, the Treasury. Let me see if I get this, because I sometimes get confused. It's the Treasury is funding the Fed to lend, or excuse me, the Fed is funding the Treasury to lend to medium and small businesses as well, to keep people on payroll. I mean, we could spend probably half an hour just listing out all the programs, but suffice to say that the Fed and central banks around the world are doing stuff that we've never seen. It's all new.
So where does all this money come from? Like,
that is the question of the age, and that's the question that I think more and more Americans and people around the world are starting to ask. And that's the amazing thing about fiat money. We have lived now for, going on 5 decades now in a world in which governments can create money at will through their central banks. Literally, the central bank, yes, they can physically print dollars, but more frequently what they do is they just credit the accounts of banks in the system. They create money literally on a ledger, and there's no cost to that. They just, with a few keystrokes, they bring new money out into the world, and they use that money to buy financial assets. And yeah, they literally create it out of thin air.
So when you have something like, we all hear about quantitative easing and QE1 and QE2 and QE infinity. Do you know what happens there? Does the FOMC get together and say, we're going to do this? Do they need congressional support? And then when they do announce that they're going to do it, how does that look? Like, is Jerome Powell giving you a call and saying, hey, Andy, I want to buy some of these muni bonds or whatever, I need to buy some assets. Like, how do you know how that works? The mechanics there?
Yeah. So yeah, I definitely don't get direct calls from Jerome Powell, although I bet you that, all the CEOs of the major banks get direct calls from Jerome Powell.
I'm sure they do.
So literally how it works is the Fed. So first of all, you mentioned congressional oversight, and although Congress has the ability to legislate, to pass laws that affect the operations of the Fed, they try not to do that, and they haven't done that, at least in a significant way, for decades, because there's this idea that an independent, quote unquote, independent central bank, right, is better for the functioning of the economy. And I believe that's true. However, as a matter of fact, when you look through history, a century or two, even in this country, there have been varying degrees of central bank independence. Now, the Fed, was created somewhat over a century ago, and the Fed actually, for the first, probably 20 years of its existence, wasn't as independent as it became subsequently, but it was given more independence. Now we've sort of come back full circle, because effectively the Treasury is funding a lot of these programs. And effectively, you've got, what Jim Bianco says is the Fed and the Treasury have effectively merged. Anyway, so Congress, yes, can pass laws that affect how the Fed operates. Now, as a practical matter, they don't. At least they haven't in recent history. Although it really wouldn't surprise me if we saw that change, sometime in the next few years. We'll see how it goes. As it relates to how do assets actually get bought, the Federal Reserve, you mentioned the FOMC, the Federal Open Market Committee. Yeah, they do meet, and they have, basically a board meeting, and Jerome Powell chairs that meeting, and they come to an agreement about whether they want to print money and in what quantities, and then in what assets they want to buy. And they actually, have a department. There's a trading desk essentially at the Fed that literally goes into the market and bids for assets. So just like anyone else, an institutional, a pension or an endowment or an investment fund, a hedge fund or a mutual fund, whoever else can call up, broker dealers on the street which are primarily affiliated with the big Wall Street banks, and say, hey, I want to buy, X number of treasuries of a 5-year maturity, today, quote me a price on that. And they literally accumulate and do trades through their trading desk. That's what they call open market operations. And
Gotcha.
that's generally how they buy treasury debt as well, I believe, as mortgage debt. And those are huge markets. Now, it's a little different when you got the Fed, underwriting loans essentially to businesses. There you've got, and this is the, the PPP or the Paycheck Protection Program. There you've got funding of the banks, who in turn the banks are funding loans to small businesses. This was, the mess that came recently out of this program was that there was there wasn't a lot of warning about when one could apply for these things. And then of course there was a rush to apply, businesses all over the country applied to get this free funding essentially, and they ran out of money. And of course, they had to jump through some hoops basically to get funded. And the companies that got funded were the ones that had the best, banking connections, right? And therefore tended to be larger on average than, your mom and pop shop or small business. So you had, like big chain restaurant companies got cheap funding, and then they ran out of money, and a lot of small businesses didn't get funding. So then there was some political blowback, and some of the bigger businesses, gave some of the money back. And now we're in the second round of this funding process, and it's just kind of a mess.
Yeah, it certainly sounds like it. So what does the Fed do with this debt that they purchase?
Yeah, they just stick it on their balance sheet. They have an asset, side of their balance sheet, and they have a liability side. And by the way, every dollar, that's printed is technically a liability of the a liability of the Fed, although it's sort of fictional. It's like you have a claim on a dollar that can be created or destroyed at will. So it's sort of a fictional concept. Nevertheless, they do account for it. And yeah, those assets they buy. So let's say they buy a bunch of 10-year treasuries, or they buy a bunch of mortgage-backed securities of some particular maturity, and they just hold that asset. And they actually they collect the interest. Right. So like the Fed actually accepts interest payments, from the U.S. Treasury. So you got one part of the government paying the other part of the government. And, over time, some of those securities, the bonds, they mature. And, depending on the Fed's policy at the time, they either, take the proceeds, right, and they go buy more assets, or they don't. Or they're buying a lot more assets, than are maturing. That's what's going on right now. I mean, the Fed's been buying assets at a rate of around $40 billion per day, which sort of makes your head spin. But that's how it works.
Yeah, this kind of reminds me. I remember when I was in probably grade school, and I was looking through like a social studies book or something, and it showed that the debt that countries had, and this was I guess in the late 90s, very early 2000s. And I remember being just like totally shocked to see that the United States had massive amounts of debt, way more than anybody else in the world. And I remember sitting there being like, but no, we're like the most powerful, best country in the world. We should be the ones, we should be the richest ones, and we should have we should be the ones that everyone owes us. I don't understand how this is the other way around like that.
Yeah, and that was and the numbers since then now really boggle the mind. I mean, they've the debt, the liabilities have just gone up and up and up. I've got some data in my book, and I have a graph in there which comes from Ray Dalio. I lifted his data. And it's the last century, and it shows debt, total aggregate debt, as a percentage of GDP, right? As a percentage of output in the economy. And, it has cycled over different periods in the last century. But basically, since we left the gold standard in 1971, it's just gone up. And it's continued to go up, including, I think you said it was, what'd you say the time frame was? Like the early 2000s or something?
Yeah, like between 1998 and 2002.
Yeah. And it's just gone up since then. And by the way, this is the actual outstanding, treasury debt, which doesn't include the unfunded obligations like Social Security and Medicare, right? So recently, total debt to GDP in this country is about 330%, okay, roughly. Now, the federal debt is, I don't know, maybe 120% of that. But the unfunded liabilities are another 1,000%, roughly speaking. So the outright debt has gone up dramatically, but it is dwarfed by the unfunded liabilities that are owed, to the older generations. Most of whom have retired.
Yes,
Pretty shocking.
Yeah. So what about?
Go ahead,
No, I was going to say something we didn't mention beforehand, so I'm kind of putting you on the spot. But what about like MMTers who say that the debt doesn't matter? It's just it's a balance sheet. We can just add to it and just keep going. And I imagine they have a reason for saying that. They're not just making it up and going along. Are you familiar with that? Or?
Yeah, no, I definitely am. They're right until they're wrong, which is sort of like saying, I don't know. It's like saying communism is a great idea, except for a couple assumptions that you have to make, which are totally false.
Right.
So yes, the factual political reality is that you can print as much money as you want. The U.S. in particular, which runs the world's reserve currency, the most demanded form of money in the world at this time, and for decades going back. You can print as much money as you want until you create so much that you end up with too much inflation. And without getting too far into the weeds, the framework I use for inflation goes back to smart Austrian economists. Mises, Ludwig von Mises in particular, he had a basic framework, which is that there's three types of goods. There's consumption goods, there's capital goods, and there's the monetary good. The consumption goods are the stuff we use every day, food and clothing. Capital goods are things that allow us to generate the consumption goods, investment, productive capacity like factories.
Tractors.
And then the monetary good, is money. Wait, what was that?
Tractors.
Tractors, exactly. Tractors are a capital good. So what happens when you print lots of the monetary good? What happens when you print lots of money? Well, it basically flows into the other two goods. And so then the question is, well, what happens to the price of those two goods? Well, with capital goods, basically the price can only go up. And that's what we've seen more or less, especially in the US with, stock prices, real estate prices. The Fed has printed more and more money in recent decades. And so the price of assets goes up as a percent of the cash flow that the assets generate. Now, on the consumption goods side, it's a little more complicated because printing money should result in consumer price inflation, but there have been a couple of factors that have kept a lid on consumer price inflation. And the two primary ones, I believe, are technology and automation, right? The more technology and know-how advances, the cheaper goods get, or let's say the more goods you can produce for, some given expenditure. That's the good kind of deflation, right? That's we figure out how to make stuff better, faster, cheaper, and that's positive for the economy overall. And then the second thing that's kept a lid on consumer price inflation was, outsourcing all the jobs to China, right? And Asia, and Mexico, and I'm speaking generalities, at least for the US. Now, that stuff is in reverse right now, obviously, because we figured out, that having supply chains that run through multiple different countries is a fragile way to be, especially when your rival, your geopolitical rival, I'm talking about China now specifically, has, different goals than you do. And you figure out that they're making the stuff that you need, to combat a pandemic, and you can't get your hands on it, at least not in time. And so that trend is in reverse. But, broadly speaking, I would say that's my framework for thinking about money and the money supply and thinking about inflation. And so where we are right now, it seems, is yes, for the last couple decades, especially since China joined the World Trade Organization in 2001, you had a lowering in the cost of production because we got to employ a bunch of cheap Asian workers instead of Americans, generally speaking, and that's changing now. So there's probably going to be an increase in the cost of productions of goods and services at the same time that the Fed is literally sending checks, to companies, to people. We can talk about the logistics of that, but generally speaking, they're printing tons of money and handing it out. And so if there's more money in people's hands to buy stuff, and the stuff is going to get more expensive to produce, that's a potential. There's a potential for the first time in like 40-ish years, significant consumer price inflation in a way that we haven't seen for a long time. And it probably won't happen in the next 3, 6, or 9 months, because demand, if the price of goods and services in an economy is cleared when demand meets supply, and demand is way down, right, because people can't leave their houses to spend on stuff. So that should be deflationary in general for some period of time, but that may within itself have the seeds for inflation within the next few years.
So how cognizant or aware do you think that these guys, and I say these guys very generally, whether it's, in the federal government, Congress, or the Fed, like understand a lot of this, like if they restrict the market or rattle things up too much, that it could all come crumbling down? Is it do you think it's like a mix? Do you think they're all kind of on the same page of understanding that, like, hey, we're doing our thing, but at the same time, we have to kind of let things operate on their own so we don't totally mess things up? Do they think that they're just gods and that they can do whatever they want? Because they are, I mean, while this is pretty crazy and it does seem like they're, just money printer go burr and their, eyes are bleeding as they run these printing presses, they are really, really good at this. And I remember I was having a conversation with a coworker recently, and, he agrees with me that they're all evil. They're doing terrible things. But at the same time, he's like, well, you're saying it doesn't work, but it hasn't, like, it is working for them and it hasn't collapsed. Yeah. So, like, do you have any thoughts on where their heads are and how long that they can maybe kind of sustain this? So I know everyone who's into Austrian economics, and I'll stop talking pretty quickly so I don't have a 8-part question. Most libertarians, people in Austrian economics, have been calling for the bubble to burst for the last since 2008 after it crashed. But like they're able to keep it going. So
yeah, it's amazing how long you can keep the game going. And so I guess I'll and this, I sort of didn't answer the original question about MMT, but that's all, all folded into this. And that is, of course, that politicians are elected on 2, 4, and 6-year cycles, and they have to deliver the goodies, right? In other words, if you got 2 candidates, and one of them can deliver, X dollars of benefit to their constituents, and the other one can deliver X plus Y. Well, X plus Y one is going to get elected. The one who ships more benefits, spends more on his constituents, and so he or she is the one that's going to get elected. And so, as long as the game can be kept going, then the bigger spender is going to win. And so how is that big spending funded? Yeah, it's funded by running deficits and incurring debt. And so so that's one thing. And then I think the second thing is, human psychology. I happen to believe this is fundamental. It's sort of unprovable, but it's like, if you believe in evolution, which I do, and we were all running around in the bush for some period of time, and then we were farming, and then only for a few hundred years that we lived in in cities, basically. Well, if we evolved in an environment in which the thing that happened for a while usually keeps happening for a while, and especially in a world with zero technological improvement, right? Like, I don't know if Homo sapiens been around for, I don't even know, 50,000 or 100,000 years. Like, those years basically all look the same except for the last, few thousand, right? When we figured out how to advance with technology. So yeah, we assume that we extrapolate the past into the future. That's the way our minds have been wired, and that was extremely effective and adaptive, until we figured out technology, which has only been, for the last whatever few thousand years. So yeah, it's just the way we're wired, is to extrapolate. And so if we assume that what happened yesterday will happen today and will happen tomorrow, and that's usually true. But if you then overlay an unsustainable, budgetary system where you're just borrowing and borrowing and borrowing and borrowing, eventually you hit the wall, but nobody knows when the wall will be hit. And it's also a confidence game, right? So for example, and I have this debate with with my colleagues and other people, in the investment industry, and they look at Japan. So Japan has huge levels of government debt, right? Hundreds of % of GDP, just the government debt. So it's actually substantially higher than we have in the US. And people look at Japan and they're like, well, they got debt to GDP of, whatever, 300%. So we can get there too. Well, it works until it doesn't, because once lenders decide that, you've reached the point of insolvency, it's not that 300% of GDP is how far you can go. You can borrow that far, and then 301% is when you're insolvent. No, there's some gray area where someone decides that things are getting a little dicey, and then they look around and other people decide the same, and then there's a big shift in sentiment. So that's the nature of these debt bubbles and these situations of insolvency, especially when you look at complex systems. It's literally impossible to know what is going to be the straw that breaks the camel's back. And so arguably, sure, the system actually has been insolvent. When you look at the entitlements, right, we talked about Medicare and Social Security, they were, certain people in government have been talking about that literally for decades, right? And it was, the problem was so predictable because it was based on demographics. I mean, there's a lot of unpredictability in the world. Demographics is one of those things that's basically predictable, right? You can have some confidence about how many people are going to die in each generation, and therefore, how much is going to have to get paid out to people who are owed money, primarily based on how they live. And even though we've known about this thing for years and years and decades, nobody's done anything about it, because if you can keep delivering the goods to your constituents and borrowing money to fund that, you're going to do it basically until you hit the wall. That's my view. And so it's like, it's short-term rational, but the system itself, can lead to ruin.
So what are your thoughts on coming hyperinflation because of this stuff? I mean, we've seen it in the past happen in places like in Germany and Zimbabwe. Do you think that's kind of on the way? Do you think that there's something different between those times and places and where we are today?
Yeah. So I think so it's funny, hyperinflation is actually sort of a technical term within economics, at least allegedly, and I don't personally really understand that. We can sort of split hairs about, how hyper does the inflation have to get before it gets classified that way. I mean, you get cases like, Weimar Germany, or Zimbabwe, where literally the value of the currency is going down by, 99% every year. Or if you invert that, it's, thousands and millions of percent inflation. That's the extreme case. I don't think that has to happen for things to get, a little dicier. In other words, we could have a scenario like the 1970s where you get, 10, 15, at moments in time, 20% annualized inflation. That's still pretty harmful. Granted, there are emerging market countries around the world, for whom, 10% inflation is just like pretty normal. But if you're a pensioner in the US, who's expecting their fixed benefit to support them for another 20 years, 10% annualized inflation, if you don't have inflation protection on a fixed payment, benefit that you're collecting each year, that can erode your purchasing power pretty significantly. The other thing I'll say too is, so Milton Friedman, famous free market economist, said inflation is always and everywhere a monetary phenomenon. And basically his message was, you get inflation when governments print too much money. There's another economist who's still alive today, that's Steve Hanke at Hopkins. And he says, actually, effectively, it's a fiscal phenomenon. And what he means is that inflation doesn't usually become a problem until governments are running heavy deficits, or basically are becoming bankrupt, right? In other words, you're not going to get a hyperinflation unless the government is basically spending way more than it takes in tax revenue. And so when you look at inflation in the US, it's been low, at least as the government reports it. By the way, I happen to believe that the government numbers are understated. We can
I was going to ask you about that, actually.
Yeah, exactly. I don't
They
believe
would
the numbers.
lie.
They would lie. Exactly. Wait a minute. You're telling me that the government, which pays benefits like Social Security, some of which are indexed to inflation, is not going to report the right inflation number? So there's that piece of it. But we've run government deficits for years and decades now. But the real risk of inflation, it seems, is more likely to hit once the government is really running big deficits in a sustained way. And we've hit that actually recently. Even before the pandemic, the government was running about $1 trillion deficit annually. That's mid to high single digits as a percent of the size of the economy. And even before the pandemic, it was like, on the Republican side, they were talking about, let's keep taxes low and keep spending. And on the Democratic side, they're saying, well, let's raise taxes, but let's spend even more. So it was like, you had two options for big deficits, but in either case, the government was going to be spending a lot more than it was taking in tax revenue. So that it seems much more likely that you get to a higher inflationary scenario when the government is spending a lot more than it takes in tax revenue on a sustainable basis. And that's basically kind of where we are now. We already were sort of there even before the pandemic, and since the pandemic, the deficit's just blown way out. But as to whether we get true like textbook hyperinflation, I don't really expect that, actually. But I do expect that consumer price inflation, or PCE, which is the Fed's preferred measure. I do expect that we go from whatever under 2% to 3, 4, 5, 6%. Yeah, within probably within 5 years, and then from 6%, it's not too hard to lose control and get to 10 or sort of high single digits. And at that rate of inflation, well, first of all, you end up with various problems in the economy, but it does reduce the real burden of debts potentially, and that seems to be it seems to be the easiest way out, basically, the debt problem, in my opinion. Yeah.
So, Slappy, did you have anything else in this kind of area? Because I wanted to change gears a little bit, or not change gears, but return.
Well, I kind of do. So, if you could briefly explain, how do they measure inflation? Like, we hear this number, and I guess the Fed puts out the inflation number every so often, and it's like, oh, okay, inflation's 2%. Where does that come from? Where do they pull that number from, and how do we know it's accurate, or should we think it's accurate for that matter?
Yeah,
which you mentioned.
That's a great question, and I'm going to tell you, it is so complex that I will probably get it wrong, but I will do my best.
Sure.
So the short answer is no. Actually, you cannot measure inflation. It is not measurable, at least in terms of getting a very precise answer. Right. And there's a couple reasons for that, right? So one is, the classic way is you do your best to figure out what is the basket of goods, that a consumer consumes in the economy. And you can do that by looking at, you can do surveys, right? You can basically ask people. You can look at what gets sold in stores. There's a few different ways that you can try to collect the data. But in any case, it's imprecise because there's always problems in measurement of this stuff. So that's one thing. And then the second thing is there's always substitution going on. So, an American today does not consume the same exact basket of goods that we did a century ago because, we got new things like smartphones and computers and, new kinds of automobiles that we didn't have. And so, and even, new sources of food and types of food to some degree. So yeah, it's a constantly moving target, and the economists do their best to say, well, we're going to adjust for the substitution of one type of good for another, but there's all these embedded problems with that because you look at something like, I don't know, well, a smartphone's a good example, or a computer is the same. How do you adjust for the fact that your smartphone is now more powerful than a supercomputer 40 years ago? So yeah, I mean, suffice to say that it's very hard to measure this stuff. Very hard. In fact, we know for a fact that the answer is wrong. It's basically based on a model, and I don't know, the economists do their best to construct that model, but there's no doubt, that it's flawed for sure. And then, so I'll just make one more point, and because I talk about this in my book specifically, which is there's a few pieces of the consumer basket, and it depends on which calculation you use, but that are actually more problematic. And one is housing. I'll just talk about housing in particular. The CPI basically makes assumptions about what they say is, some Americans rent and some Americans own their homes. And in any case, every American is consuming, in quotation marks, consuming, shelter, right? So this is a good or service that we consume is the roof over our head. And instead of, sort of measuring actual rents, what they do is they basically impute rent based on home ownership. They say, homeowner, the cost of housing for you is some, estimated imputed rent that you might charge somebody for living in your house. And that is,
Yes,
it's a guess. It's totally a guess. And what's interesting in particular about that guess is the rent that springs from, the rent that one would charge someone to live in a house is based on what is the cost of owning the house. And the cost of owning the house is in large part based on the mortgage interest, that the owner pays the bank. And so in a world where interest rates have gone down and down and down for the last 40 plus years, that's held down. It's held down the rent effectively. So it's true that rent levels in the whole economy have been relatively subdued. But on the other hand, it's also jacked the price of that house way up at the same time. And so, in my book, I've got a fictional conversation between myself and my little brother. And he doesn't own a house yet. And in the conversation, I'm saying, great news, bro. Rents have been held down by lower interest rates. And he's like, well, yeah, but I don't want to rent forever. I want to own my home someday. And the same house basically that was, say $500,000 in a major city, and therefore you had $100,000 down payment and borrowed 80%, now is $1 million. And the interest rate is lower, so your mortgage payment might be the same. But now instead of $100,000 down payment, you got to scrape together $200,000 down payment. And that's a tough, that's a high hurdle for your average millennial person. I mean, scraping together a couple $100,000 to make a down payment on a house is no easy feat.
No.
And that's why, one of the things I worry about for the future is, an entire generation has basically been priced out of the housing market, right? And this is a big problem.
Yeah, it's pretty wild to hear. I mean, I know my dad talks about it, how much, houses cost when he was buying, You know, even in the 70s and you know, generation before that, it was, you know, basically everyone owned a house, single income, kind of blue collar work, and you could afford to buy a house, not even, you know, take out a, you know, most people are lucky to put a 20% down payment nowadays, even, you know, on houses that aren't, you know, let's not even talk about the $500,000 house.
Exactly.
Yeah, let's talk about a $150,000 house, and, you know, a lot of people are putting down single digit
Whatever the
down
minimum
payments.
FHA loans or whatever.
Yeah, that's right. They're borrowing huge amounts of money. Yeah, gone are the days. Exactly, gone are the days when you could get a decent job, you know, without having, you know, a very expensive education, and you could, yeah, probably over a period of a few years, scrape together that, you know, that purchase price, you know, or the down payment and borrow the rest, and you could have a few kids and you could live, you know, more or less securely. Yeah, that's a bygone era.
Yeah, it's crazy to think where we are compared to not that long ago. So I wanted to take it back a little bit. Earlier on, we were talking about the recent quantitative easing the Fed has been doing, but throughout the last month or so, especially early on when the markets were crashing, we heard a lot about repos. Can you talk about what that is and what the difference between a repo and quantitative easing is?
Yeah, sure. Okay, so a repo stands for repurchase agreement, and a repurchase agreement or repo is a deal in which one party has valuable collateral. Usually that's a government bond. So let's say I've got, you know, $1,000 government bond, and I own that asset, but I need the cash for some reason. And so I go to a counterparty and I say, let's do a repurchase agreement. You give me the cash, I'll give you the bond, and then I will promise to buy the bond back from you tomorrow or next week or next month at a slightly higher cost or price. And embedded in that is an interest rate, right? So you give me $1,000 for the bond today, and, you know, tomorrow I'll give you $1,001 to buy it back. And so what the repo market does is it allows, you know, banks and funds and other financial entities to take debt instruments. And again, like I say, it's primarily government bonds, but it's also mortgage bonds and other sorts of debt instruments, and access cash on a short-term basis. So that, in a nutshell, is the repo market. And it's interesting. The repo market is huge. I don't actually, you know the figure off the top of my head. You know, it could easily be, you know, $1 or $2 trillion. And it's a major market. It's a major funding market for banks and other financial institutions that need different amounts of cash at different times. And the recent history of the repo market was, it actually broke down last September. Basically what happened was, you know, treasury bonds are considered quote unquote good collateral, i.e., you know, the odds that $1,000 bond is not going to be worth $1,000, you know, in the future is extremely low. And so this was sort of considered, you know, the normal boring plumbing, or a piece of the normal boring plumbing of the financial system, you know, just like everything is until it fails. And it did fail in September. And, you know, basically the implied interest rate in this market tends to be low, you know, single digit percentages, but it blew out to, I can't remember, I think it was like 10% plus annualized. And that's not normal. In other words, if I go to, you know, borrow, if I'm willing to post collateral and it's really high quality collateral to borrow money, I shouldn't have to pay a 10% interest rate on that. But that is what happened for a period of time in the markets in September. And that was, you know, a clue that something was not right in financial markets. And in fact, that's when the Fed stepped in and said, hey, you know, the repo market's not working. We're here to support it. So we will provide, you know, repo funding. Basically, you know, anybody, banks, funds, whatever. By the way, banks and hedge funds. This is interesting, right? Banks, which are regulated by the Fed, and hedge funds, which are not regulated by the Fed. You can come and post us, good collateral, and we'll give you, we'll let you borrow cash on the cheap.
So, bank, they have, this asset like a bond or something, and so they say, we need cash for whatever other operation they're doing. So the Fed comes in, makes this repurchase agreement that the bank's they're going to buy it from them, give them cash. And the bank's saying that in a certain amount of time, we're going to give you, we're going to buy it back with a little bit of a premium on it. So what happens if the bank doesn't have, doesn't really have the cash later on to buy that back? That's what's always kind of been confusing to me, and even before I started digging into this stuff, it just seems like, well, isn't this just kind of making like this cycle of constantly needing to go to this well over and over and over again?
Yeah, absolutely it is. I mean, you saw it was interesting. This problem became a big problem actually in the last couple months. So one of the markets that was most dislocated was the mortgage market, particularly the mortgage-backed securities market. So this is, both mortgages. When a bank lends money to a buyer of a house, they take that mortgage, they package it up into a pool, and then they sell claims against those assets, and that's called a mortgage-backed security. Well, mortgage-backed securities, at least the high-quality ones, generally fall into that category I mentioned earlier of, quote, good collateral. Stuff that's, deemed pretty safe, and is not likely to, it's extremely unlikely to default and extremely unlikely even to trade down significantly in price. However, this is a universal truth, as you can take any safe asset and make it risky, or make a structure risky, if you borrow enough against it, right? Which is what you're getting at. If you apply enough leverage, right? If I take $1 and I buy $50 worth of mortgage-backed securities, and I fund that by borrowing in the repo market, right? I go buy those securities and I pledge them as collateral, basically to fund the purchase. Then if I have a problem in that short-term lending market, well, I get a margin call, and I have to sell that collateral, and the price of the collateral goes down, which means that it's deemed as not such good collateral, and maybe I can't get $1,000, for that bond. Maybe it's $999, and then it's $990, and it's $950, and now it's $900, and now it's $850, and you can get cascading liquidations. And this is true in every levered asset market, from mortgage-backed securities, to Bitcoin trading on BitMEX. I mean, it's the same always and everywhere. And that's exactly what we witnessed recently. And I agree with you 100%. Levered structures that depend on debt are inherently unstable. And they are especially unstable when the debt is, short-term or has short-term maturity. I mean, it's one thing if I go borrow, to buy a house, and I get a 30-year mortgage, and as long as I can make the interest payments, right, I can't have the rug yanked out from under me. But imagine if your mortgage, matured and you had to reborrow every week, right? Well, right. If you catch me at a bad time, maybe I've lost my job, right, and I can't prove my income at that moment when you have to re-underwrite the loan. Well, then I'm screwed. I get, the loan called in, and the asset gets liquidated under my feet, and that's the dynamic you get in markets that have high amounts of leverage, and especially when the leverage, the loan rolls over and matures, daily or weekly or on short timelines.
Yeah, it would be like the difference between, say, a construction company that takes out debt in order to buy some more trucks or other equipment as a way to expand their business, as opposed to having to take on debt to make payroll. every month.
Right.
Yeah,
I like that.
yeah, you could see that as being like, whoa, one thing's, that's a good business move. You could take on a liability, but you expect to be able to expand your business and you're going to grow, as opposed to you're just like, you're done. I mean, anyone can see that.
Yeah. I mean, imagine, let's go back to the tractor just for the fun of it.
Sure.
Imagine the farmer that borrows, 50 grand to buy the tractor. And he does a 5-year loan because he's like, look, that'll give me 5 harvests. That'll give me enough cash flow to pay it back. Versus if it were structured, like the short-term lending market or the repo market, it would be like he borrows the money and then the loan matures, every week. And 6 weeks from now, the lender says, we're not feeling that great about next year's harvest. We've heard that rainfall is going to be a little worse than expected. So we're going to either need you to post more money or we're just going to call in the loan and liquidate your tractor. And the farmer's like, well, wait a minute, that doesn't work.
Yeah.
Short maturities will get you.
Yeah. Did you see the video that was floating around Twitter about the girl showing how to operate a tractor?
No.
She's in one of those like huge, major farm tractors, and it's just, you would think it's just, it's maybe got a steering wheel and the clutch and shift gears and maybe a couple levers in there, but it is like there's 4 computer screens in there. There's autopilots. There's all sorts of stuff. So it shows that right there, the idea of farming. Who was it? Someone in the government recently said like, you just get some dirt, put a hole in the ground, cover it with seeds, and water it. Like the complexities of this stuff have become so great for us to be able to produce all that we have.
Yeah,
that you start rattling that cage and shaking things up. I mean, you just taking away those tractors from those farmers. Just your production's going to go way down. So it could really, and then you just look at that across all different sectors of the economy, and you realize, oh man,
yeah, man, deleveraging, right? When loans get called in is extremely painful, right? That's what happened in the Great Depression. That's what almost happened in the global financial crisis, 2008, 2009, and that's what was happening until what was happening early this year. Until the government stepped in and said, "Look, we're going to print as much money as it takes to backstop the economy," and they seem to kind of sort of be succeeding at that. Although it's hard to implement these policies effectively. But yeah, man, when deleveraging occurs, it's a bad time. It's a bad time for just about everyone.
Yeah, so I don't know. Is there any more of the bad stuff you feel that we need to touch on this? Because I want to ask the question that everyone knows it's coming.
Yeah, I mean, look, we could go on and on, but I think you asked some good. No, we covered a lot of the meat of it, and you asked some good questions. So I'm happy to leave it there for now.
Okay.
So are we just screwed, or is there something that could fix this?
Yeah.
What could
possibly fix this?
What could possibly fix this? Yeah, I mean, I studied economics in college, and it was the wrong kind of economics. I was very, very poorly prepared. I was taught Keynesian economics, and I wish I'd been taught Austrian economics. And the Austrians teach us that a hard money standard is the way to go. If governments can print to infinity, then you end up with too much debt. And then ultimately you end up with inflation or defaults or war, right? Bad outcomes. So I believe we have to return to a hard money standard that used to be gold. I have high hopes for Bitcoin, obviously, because it's like gold, but in some ways a lot better. And, that's why I went to the trouble of writing a book about it. And half the book is about money and debt, and then the second half, of course, is about Bitcoin. But I am optimistic for the future of money based on the idea that it'll be a hard money. And I think that the money that's got the best shot at being widely adopted as the hard money standard is Bitcoin.
So why do you think that, why do you want to go for Bitcoin and not go back to a gold standard?
Yeah. Well, I think there's a couple reasons. One is it's already been tried and it's failed. And the reality is gold tends to get centralized. I mean, the history of it is always that, yes, there's been gold coinage, but as a practical matter, people just end up entrusting centralized counterparties to hold their gold and then issue paper slips or receipts against them, and then they trade the paper claims. And every time it seems through history, governments somehow manage to centralize control of gold, and then they offer, they have a gold back standard or a hard money. I mean, it's been silver at times as well, in the last few centuries, but basically they promise to give $1 worth of gold for every dollar they issue, and then eventually they break the promise. So it's kind of this cycle that just keeps repeating, and it just doesn't it never seems to end well. It always ends up on a fiat system or a fractional reserve system where your paper claim is only partially backed or even not backed at all by the actual hard money. So that's why I think the gold standard is unlikely to work. I actually think that a gold standard would certainly be better than what we've got. And if God forbid Bitcoin fails, but we get back to a gold standard, that's a better world. So I'll be happier about that outcome than the system we've got now. But I think that Bitcoin is harder to centralize in the way that gold has gotten centralized and controlled by governments. And it's also harder, a harder money in the sense that it's harder to produce. We're a couple weeks away here from the halving, in which the annual inflation rate will fall below 2% and therefore be comparable to the annual production rate of gold. I should say the issuance rate of gold and the issuance rate of Bitcoin will be the same, roughly, for the next 4 years. And then after that, the issuance rate of Bitcoin will be even substantially less than gold. So it becomes an even scarcer money than gold. And so that's one of the, and then obviously, it's transportable at, almost no cost across the world, and it's harder to confiscate. And we know exactly, how much of it exists, but we don't know how much gold there is in the ground or on asteroids, et cetera. So there's various reasons why Bitcoin is actually better. And so that's why I'm more bullish on Bitcoin in the long run than I am for gold.
So how do you think that, I want to make sure I ask this question well. What kind of a world do you think like a Bitcoin standard is? How does Bitcoin make governments and central banks behave? Do we think that this is going to destroy central banks and they no longer exist? Or do you think that we'll see central banks and governments starting to use Bitcoin more and kind of jump off the dollar?
Yeah, I think there's a few ways it could play out. I don't think central banks, go away anytime soon. A decade from now, they'll still be around. 2 decades from now, they'll probably still be around. But if Bitcoin succeeds, it will impose some discipline. So in other words, the incredible rate at which we're printing dollars right now, in a Bitcoin standard world, nobody's going to want to hold the dollar if it's getting, printed in such quantity, because the value of those dollars just goes down over time in Bitcoin terms. So it'll impose, I think, more discipline on government currencies and central banks. And then what you suggested, could central banks adopt it? Yeah, that's very possible. In fact, it wouldn't surprise me at all if some central bank somewhere around the world, has started accumulating a little bit of Bitcoin. Because the nature of fiat currencies today is, in some respects, they're not totally unbacked. I mean, the US government does own some valuable assets. And there have been times in history when, currencies have been partly backed by hard assets like gold. And there's Facebook with Libra, tried to create a new system of money that was going to be backed by a basket of other assets, albeit they were, fiat based. But, there's different sort of hybrid forms. I mean, it's not impossible to imagine the government money that is, part backed by Bitcoin and part backed by gold and, part backed by something else. I think it's interesting to look at what some foreign central banks have been doing. I'm talking especially about China and Russia. They've been accumulating gold in large amounts, in the last decade. And it wouldn't shock me to see, one or another of those, issue a gold-backed currency or a partly gold-backed currency, or you could even see, multiple governments, do some kind of consortium, and create a new form of money that's, partly backed by hard assets. I mean, there's a lot of ways to do it. So, but the short answer is, I don't think that government central banks and government monies are going away anytime soon. I just think that their role will be reduced, and they'll have to be more disciplined, basically, about how much new money they print.
Yeah. Yeah, there was.
How's that for a diplomatic answer?
No. I think it's real. I mean, people see me and a lot of other Bitcoiners, going around screaming, "Bitcoin fixes this, Bitcoin destroys all this stuff." But it's a process. And,
oh yeah,
and
it always takes longer than you think it will. I mean, when you you fall down the rabbit hole and you do your homework and you talk to people, and then you get it, and you're like, okay, this is the thing, and then you look around and you talk to other people and you try to have conversations, you try to educate them, and you realize, man, it takes a long time. It takes a long time for people to understand it. That's why I'm partly in the Bitcoin education business, right? That's why I wrote the book. I knew I was going to have to explain it to my clients, who I manage money for. And, I knew that it was going to be an uphill battle, and there's no way you can explain Bitcoin in one conversation or two or three. And yeah, man, it takes work for this mind virus, for this idea it takes work and time for it to spread through the population.
Yeah, I think one of the big points about Bitcoin and in what we're talking about is how it can break up the cartel of the central banks, at least. Right in front of me is I've got a Raspberry Pi that I run Bitcoin Core and BTC Pay server on. And I mean, that right there competes with central banks if they take a Bitcoin standard, because I can validate any Bitcoin all Bitcoin transactions that are going on. I can do that just by running a very small, cheap hardware on a crappy internet connection, as opposed to clearing all these major transactions that these central banks do. Whether it's
isn't it amazing? Instead of paying $30 to send a wire, and it only clears once a day, you can buy a cheap piece of equipment, hook it up to the internet, and of course the cost of that node goes down all the time as compute gets cheaper and bandwidth goes up, and it's an amazing thing.
Yeah, and just even imagine trying to do that, trying to validate all the world's gold transactions, including validating that it's actually gold.
That's right.
The purity of it and everything. I mean, it's just that right there is just an unbelievable innovation that puts me at the same table as literally anybody else in the world with transferring major pieces of money around. So I think that's just that alone right there makes me unbelievably bullish on the future and what Bitcoin has.
I agree with you. It's the ability to identify and assay, the value of what you think you have. It's huge.
Yeah, I think a lot of people take a lot, like even the gold standard, they take all the layers that are required to have a functional gold standard. It's not just, you don't pull gold out of the ground and it's in the form of a coin. There's a lot of trust. There's a lot of centralization that has to happen, and a lot of it, we say that gold failed and everything, and I think the people get confused in that they say, oh, it has no functions right now in this moment of time, or that it was a failure all throughout its time as a monetary standard. That's not the case at all. It did absolutely wonderful things. It's just broken. They figured out the security flaw in it, and I agree with you that if we return to a gold standard, that it would be better. I would like it better than what we have now, but we're just rewinding the tape.
I totally agree with you. And in my book, by the way, I identify 14 characteristics of money, right? And they are identifiable, transferable, durable, divisible, dense, scarce, fungible, short-term stable value, long-term stable value, unseizable, censorship-resistant, private, required for some important purpose, backed by a powerful agent, okay? And I score the dollar, I score gold, and I score Bitcoin. And what you just identified, or what we've talked about through this conversation, is Bitcoin outscores gold in several of those, key areas. Identifiable, it definitely outscores it. Transferable, it outscores it. Durable, maybe the same. Divisible, it outscores gold, although you could argue paper claims, against gold are divisible. The density, probably the value density is comparable. Scarce, today they're comparable, but Bitcoin will win out there eventually. Fungibility, Bitcoin wins. There's all these, privacy. I mean, there's all these categories in which Bitcoin is just empirically better. Mm-hmm. And moreover, it's improving, right? So as the layers get built on top, as the user experience improves, with all the smart developers and entrepreneurs who are making it dead simple to use this stuff, it gets better. I mean, gold is not improving as a money. I mean, you could argue that obviously it's declined, but I guess what I'm saying is the technical. Well, in prior rounds of the gold standard or the silver standard that ultimately failed, yes, people figured out ways to deal with the problems, but we did all the innovation probably that was available, since this stuff's been around for a while. But people are still innovating really fast on Bitcoin, so it's improving.
Yeah, the unfortunate technological innovations with gold were just created major backdoors that could be exploited by someone. And that's what I try to explain to people is like, all right, if you want to go back to a gold standard and you don't want to just, we said before, just rewind the tape, you have to have some sort of technological innovation that prevents these things from happening. And I don't know, I'm not going to say it's impossible, but there's been nothing there in that area. And so
that's right. Yep. Nobody's figured out anything new on how to improve the gold standard in a very long time.
Right. So we're talking about Bitcoin a lot. So I don't know. Is there like I
was going to say let's be mindful of time.
Is there like a free market success story that we can that exists out there on how to acquire Bitcoin?
Yeah, man, and I'll use that opportunity to shill the one Bitcoin company that I'm invested in and affiliated with, and that is Swan Bitcoin. And Swan has two products. One is called Give Bitcoin, and it does two things. It allows you to give Bitcoin to someone who isn't a hardcore Bitcoiner who knows how to handle it, and it wraps it up with an education program. To get them up the curve, basically on what it is and how it works. And then they got another product, which is basically a DCA, dollar cost average stat stacking program, which lets you link your bank account basically and just buy whatever quantity of Bitcoin you want to do on a weekly basis, and accumulate over time so you don't have to think about timing the market, or getting too clever with trading, which I don't like to do. I mean, it's a good way to get your face ripped off. I mean, granted, there's a few people that seem to be able to do it consistently well, but man, if you're not spending all day at it, it's just not worth the time. But they got the cheapest dollar cost averaging service out there, and it only takes a couple minutes to get it set up. So yeah, I would say that Swan is bringing Bitcoin to the masses. They're trying to get they're trying to create another 21 million Bitcoiners, and I'm excited to be an investor and to be an advisor there. And it is a free market phenomenon. It's people saying, hey, I want to stack sats. I want to accumulate some Bitcoin. I want to own, I want to own freedom money in a free market, and I'm voting with my wallet.
Yeah, that's awesome.
Cool.
Yeah, I know. Sorry. Yeah, I know a lot of people. You mentioned trying to time the market. I know a lot of people, especially people who are trying to get into it, they worry about that. It's like, oh, when's the right time to buy? And I always tell them right now. And I used to try to trade early on and time the market a little bit, and it was just wasted time. I think you're better off, that time that you're going to spend trying to learn or study that stuff, you're better off just making dollars and just
totally
buying Bitcoin as those dollars become available. And so I think I was actually checking out Swan today. I was going to sign up. I didn't, but that's going to be something I do very likely in the near future.
Yeah, so, no, I use the product, swanbitcoin.com, and it's basically, because I've looked at the space for a while, and obviously I wrote the books. That's my other sort of Bitcoin product, but it's as far as my ethos and my vision of what Bitcoin should be for people, which is a saving and investing tool where you accumulate over time to own the money of the future. That's basically what they do. They're an on-ramp. They're not an off-ramp. They're not about trading. They don't offer any other coins. It's just about Bitcoin.
Yeah, that's awesome. So that will be in the show notes page, mcflugel.com/196. And Andy, do you want to tell people how else they can get in touch with you, and where they can buy your book?
Yeah, totally. So the book is called Why Buy Bitcoin? Investing Today and the Money of Tomorrow. It's available on Amazon. And it's a soup to nuts, understanding Bitcoin book. It's, higher level than the really very basic, books out there. So it gets into the meat of what is money, what's the situation with debt out there, what is Bitcoin, what could Bitcoin be worth someday, and what are the risks. But it's also not, it's written in a readable format, so it should be readable basically for any intelligent reader out there. But you can also get it on Apple, but Amazon is the primary channel. And then follow me on Twitter. It's my handle's Edstrom Andrew. So it's the last name, first name, Edstrom Andrew. And then I got a personal website. It's andyedstrom.com, and you can find other podcast appearances and stuff that I've written on there. And I'll give the disclaimer now that I should have at the beginning, which is none of this is investment advice, and these are all my own opinions. They're not the opinion of my employer, which is a wealth management firm called Westcap Group. But if you want to learn about that, it's westcapgroup.com.
Awesome. That'll all be on the show notes page. Again, mcflugel.com/196. Andy, we really appreciate you coming on. This was a great conversation. It's probably going to be one of the episodes I go back and listen to just to make sure that I catch everything you said, because it was very information dense, a lot of good information, a lot of stuff that I think a lot of libertarians might be kind of aware of, but might not understand some of the more nitty-gritty details. So appreciate you sharing all of the knowledge that you have.
Hey, pleasure's mine. It's been a blast. I love your pod, so keep up the good work. And it's been fun.
All right,
thanks. We'll talk to you soon.
Yeah, thanks for listening, everyone. We will catch you next week. Make sure to buy Andy's book and check out Swan Bitcoin and everything else. Follow him on Twitter. He's a good follow.
Peace.